Imagine finally buying your first home, right? And you still making payments when you're 85 years old. I know that sounds wild, right? Look, mortgage rates sitting around 6.3% right now. Some are seriously considering 50-year mortgage. But does stretching your loan that far help you or does it trap you? So today I'm gonna break down what the numbers really say and how this can impact you if you're trying to buy a home in 2026. So why this might matter. If you're a buyer in this market, you already know affordability is tight, mortgage rates are holding pretty steady. So here's a quick snapshot of November 17, 2025 and where our mortgage rates are today. VA 6.15, and you have the jumbo 6.44. So then with that, you add in record high home prices and tighter lending standards, and we got a real squeeze for most people. So the idea of a 50-year mortgage is gaining some traction. But before you jump in, let's break down real numbers. So what is a 50-year mortgage? A 50-year mortgage is exactly what it sounds like. It's a loan that spreads your home payments over half a century. The upside, you get lower monthly payments. That can be helpful for first-time buyers just trying to get in the door, right? But here's a twist. You're committing to pay for that home into retirement and maybe beyond that. So is the short-term relief worth the long-term cost? So let's see why some people would consider the 50-year mortgage, right? So some benefits could be lower monthly payments. Depending on the price of the home, this could save you maybe $100, $200, maybe $300 a month. That could be huge if you're kind of tight on cash. A smaller payment means better debt to income ratio, making it easier for most people to get approved. Another thing is more buying power, right? Maybe you can afford that extra bedroom or that better location that you always been wanting. This is the path to home ownership for some families, especially in high cost cities. In the market where affordability is an obstacle, these could be some real advantages for a lot of the first time home buyers. Now let's talk about the long-term trade-offs. You pay way more in total interest. So over 50 years, you're paying hundreds of thousands in interest, way more obviously than a 30-year mortgage. You build equity very slow. For example, 10 years of a 30-year borrower, they might have paid down $50,000 in principal. 50-year mortgage, maybe about $10,000. So you're still paying into retirement. Think about that. You're 75 or 80. Do you still want to have a mortgage? Short-term home ownerships may see no benefits. Most homeowners sell or refinance within 8 to 13 years. You may have paid interest without ever building real ownership. What am I sacrificing for that short-term savings? So for me, look, simple. This is what I want to know personally. Would you take a 50-year mortgage to buy a home today if it dropped your payment, let's say, $200 a month? Would you do it? Or would you wait, save, and aim for that 30-year or 15 loan instead? So drop your real answers in the comments. Type info and I'll send you a breakdown of what numbers could look like for a 30-year versus a 50-year in a side-by-side comparison. Again, for those who don't know, I'm Dwayne, a local realtor in the Northern Virginia area, an expert helping people to navigate one of the most confusing markets we've ever seen. Every week, I'll be breaking down real stuff and what you need to do to buy smarter, not just faster. If you're tired of hype, click the button, subscribe, hit that bell. You deserve a real path forward, and that's what I'm here to help you find.